The number of job openings in the U.S. hitting a new 3-year low in April, the latest sign of a cooling labor market ahead of that big Friday's jobs report. A weakening labor market could help bolster the case for the Fed to lower rates in 2024. Our next guest expects 2 cuts by the end of the year. With us now to discuss all this is Michael Kantrowitz, Piper Sandler Chief Investment Strategist. Michael, good to see you on set.
Thanks.
So let's start there, that economic data, because we got more this morning, and demand for labor seems like it continues to moderate, and it kind of, this kind of general drumbeat now of maybe some softer data we're getting. What do you make of it? What does it mean for the market?
Yeah, I think it's more of the same. The chart you guys just showed, it was just a downtrend that's been going on for a while. There was a bit of an acceleration in this month, but when you look at the broader jobs data from everything from non-farm payrolls to the unemployment rate to temp employment, hiring plans, quit rates, et cetera, there's been this underlying slowdown going on for about a year. It's broadening, so there's more data points slowing than are strengthening. I still think it's good news for equities that it helps to quell inflation fears. And I think we've got a ways to go before we have to worry about a real hard landing taking down equities broadly.
One of the charts in your latest note I thought was really interesting, where you talk about a potential generational shift in investor psychology. And, for the past, decade, we had yields and stocks going in the same direction, which had reversed the couple of decades before it. Are we now seeing another reversal where we're going to see renewed inverse correlation between yields and stocks? And what does that mean? What are the implications of that?
Yeah, it's, my entire career, I started roughly in 02, 03. Basically up until COVID, we did have a positive correlation between interest rates and stock prices. And that basically, to me, tells us that no one's really worried about inflation. And when rates go up, the economy's getting better, the markets are going up. From, again, the last 20 years, not a lot of concern. That changed with COVID. It changed due to zero rates and these big refinancing gaps we have in commercial real estate, residential real estate, corporate credit. So I think because of that, it's going to persist, this negative correlation between rates and stocks for a while longer. In the 70s and 80s, it happened because we had really high levels of interest rates and inflation. We don't have really high levels. We just have these big high gaps between where rates were because of zero interest rates. So I think there's a lot of reasons, but until we see investors not worried about higher inflation, higher interest rates, a rate hike, when the data improve, I think we're going to continue to see this negative correlation, not literally every day. I know today yields are down a bunch in the last couple of days, actually, and stocks really haven't positively reacted. But if you run that correlation over a real short period in time, you'd see it flip-flopping a lot, whereas I look at over about 6 months to really capture a regime, and it's been pretty negative for about the last 2 years.
We mentioned, Mike, you're expecting 2 cuts from the Fed this year. What if that didn't materialize and you had no cuts? Would that change your view of the market? Does it need cuts to keep moving higher?
I think I think smaller caps, areas, mid caps that don't really have robust or broad-based earnings strength. Yeah, I think regional banks, transportation stocks, real estate stocks. There's a long list. Again, this all goes back to all these names that are rate sensitive. Does the large cap growth index, the 500, need lower rates? Not necessarily, because there's still earnings growth there. Will the growth will stock prices go up as much without rate cuts, or if the 10-year yield stays here? No, I don't think so. So I think if rates stay where they are for longer, it's more of what we've seen with this large cap quality growth leadership, small cap value underperformance.
And at the same time, even though we've gotten a couple of, or maybe more than a couple of negative economic data points at this time, you, again, in your most recent note, you talk about maybe some stabilizing factors that are underpinning the economy that give you a little optimism that, maybe things aren't going to be fantastic, but maybe they're not going to be a lot worse.
Yeah, I'm taking a little bit from the bearish economic side and a little bit from the bullish economic side and kind of landing in the middle. The bullish economic story is that oil prices are low, we have a lot of fiscal spending, we've got a flexible labor market, a strong wealth effect from the boomer generation, and all of that's going to prevent a recession. Well, maybe, but with all of that said, we do see the JOLTS data coming in weaker. We do see softer underlying earnings when we look more broadly. So we are seeing a slowdown with all of that. But perhaps it means it's a more moderate slowdown. Perhaps this is why some like me and others last year were wrong in calling for a recession earlier because of these mitigating factors. And so I think the Goldilocks environment today is that it just continues to offset some of the impact of higher interest rates, and that we just continue to grind slower, not fall off a cliff like previous recessions we have seen.
And Michael, let's sort of add it up for viewers who are listening right now, given that kind of viewpoint you have. Where do you see opportunity in the stock market? What are you screening for?
Still, quality companies with higher profitability. I think one of the sectors that's interesting is utilities. I've kind of said it could play Iron Man offense and defense. It's a football reference, American football. And so utilities have certainly played offense for the last 2 months, playing with the kind of on the back of the AI story and the drop in yields from 4.7 about a month ago. And if things do become bad, and bad news becomes bad for equities, and I would presume rates would go down, and utilities there can be your kind of safety play as they have the most stable earnings backdrop. So aside from that sector, generally just looking for stocks within different sectors and industries that have the best earnings momentum relative to their peers.
And just real quickly, utilities is unusual because it's already had a run, even though rates haven't really come down because of this whole now AI thesis about them as well. But you think they have more room to go if rates do come down?
Yeah, I think if we do end up having a hard landing recession, things get worse, utilities will be the last part of the market hanging in there. Perhaps, again, maybe not the AI stocks that have led the move, but you'll see a rotation within utilities to more stable bond-like equities within there.
And that's perfect because we've got our playbook today on utilities. So we're going to get some specific
nicely
names
timed.
as well from folks to how to play that. Thanks so much. Good to see you.
You too. Thanks
For being here.